Are you currently investing wisely, or you're making some mistakes that could cost you very big? Today, I'm going to be discussing about the 6 major financial asset classes. We're going to be discussing about the pros, we're going to be learning about the cons, and which one best fits your current financial situation. I want you to stick around because this could be the difference between your financial success and your financial failure. So let's dive in. When we say financial assets, these are assets that relate to your money. And we have 6 major financial assets. The very first one is your savings, your cash and cash equivalents. Under this type of assets is where we have your savings account, we have your GICs, which is your guaranteed investment certificate, we have your money market funds, and we have your treasury bills. Now, for savings accounts, it means you're basically putting away some certain amount of money into an account, saving it for maybe the future or for something, maybe for an emergency fund. For mutual fund, money market fund, it means you're putting your money in an overnight deposit, or maybe a 7-day deposit, a 14 days deposit, basically short term. When you say cash and cash equivalent, it means short term. You need it maybe in the next 1 week, in the next 2 months, or possibly in the next 6 months. That's why you're putting the money into this account. So what is the pros for this kind of portfolio? It's high liquidity. That's the very first one, because you can easily access your money at any time. Just imagine your savings account. You can go to the bank today and withdraw your money from your savings account. Same thing with a money market. You can say, okay, I'm leaving it for 7 days because I need this money to be used in the next 7 days. Then you have the low risk of capital loss. Because this is a very short-term return, the risk of you losing your capital is very low. Then you have the useful for emergency fund. That means you're using it for emergency fund, especially when you're saving for an emergency fund, because you can call for your emergency fund at any time. Then this type of portfolio might be very best for you to use. Then you can predict the return. So when you say a savings account, it tells you it's going to be 1% per annum on your return. So the return is easily predictable. Those are the pros. So what are the cons? You have low returns. Because this is a very short term and low risk fund, the returns, it's very low as well. Then you have limited growth opportunity. So when you say limited growth opportunity, just like it relates to the low returns that you get from it, because your capital is not likely to really appreciate to even eat the inflation we have on the ground. Then the second class of assets is the fixed income security. This is where you have your bonds and your debt instruments. So when you say bond means you're borrowing your money maybe to a government or to a list institution. So you give a bond, the bond is always timed. It can be maybe a 3-year bond, a 4-year bond, and at the end, you get coupon. This interest is called coupon when you're doing debt instruments. So let's add, what type of bonds do we have? We have the government bond, which might be the federal government bond or the state government bond. We have the corporate bond. These are A-list companies that issue out bonds to people. Then we have the municipal bond, and we have the fixed deposit as well. So for the government bond, it means government might say, okay, I want to maybe construct some road, and I need maybe $10 billion, and they'll issue out a bond. They say, okay, I'm issuing out a 5-year bond for 7% coupon. It means people will subscribe to that bond, they will lend the money to the government, and the government will pay them back the capital at the end of 5 years. However, the coupon, which is the 7% coupon now, for this example, will be paid to them quarterly or yearly. So you discover that your capital will be preserved, but capital will be paid back to you at the end of the bond, the term of the bond, or you get returns on a quarterly basis or monthly basis or half yearly, or maybe it's paid annually. It comes to you. So what's the pro for this type of portfolio? You have low risk return, because compared to stocks, the risk that is associated to it is low compared to the stock, because it's not volatile. You already know you're borrowing it to the government, and government will pay. And if you're giving it to a corporate organization, It's definitely a A-list corporate organization, and they already have a track record of them not defaulting on those bonds. It provides a steady income. So when you talk about the coupon, I mentioned the coupon in the example I used, where I said 7% coupon. That means you already know that, okay, at the end of each quarter, 7% comes to you. That's 7% per annum, so it's divided into four. At least you already know certain amount comes to you at the end of each quarter. There is good for capital preservation. So if you have a capital that you're not going to be using in the next 3 years, you might want to put it in bond, especially if you don't want to put it in stock. Maybe you don't want to take the risk. So these are the three pros that we have for this type of portfolio. Now, what are the cons? Interest rate risk. So because the interest rate is already fixed, you do not, it doesn't change based on whatever the market is. So it's possible that the interest rate might be low and you have the inflation risk as well. So it's possible that the interest rate you're getting on this bond is already fixed. Maybe it's a 10-year bond, a 5-year bond. So it means it does not matter what inflation does at that time. It's not going to change the interest rate, especially if the inflation goes up within that time. Then you have the credit and default risk. So it's possible that the company, maybe the corporate organization defaults on you, or it's even possible that there's a change in the government and the government does not want to pay that bond. However, it's very low. The risk is low as well. But these are the cons for this type of investment, portfolio. Then we go to the third investment portfolio, which is the equity. So for equity, this is same thing as stocks. It's generally known as stocks. You have the common shares, you have the common stocks, you have the preferred stocks, you have the exchange traded fund. Now, when you say common stock means that you're part of the common shareholders of that company. It means if anything happens to that company, you're the last people to be paid off in that company. Then we have the preferred share. The preferred shares takes privilege over the common shares, but it is not always available to, or you have to get maybe be part of the common shareholders before you now move to the preferred shareholders. Then you have the exchange traded fund. So when you say exchange traded fund, that is the ETF. And what it does is you group a certain number of companies together under the same portfolio. So when you talk about the most popular one now is the S&P 500. When you talk about the S&P 500, that means the best 500 companies in the USA. So those 500 companies have been grouped together under an exchange traded fund. So when you buy one S&P 500, you're buying a bit of those 500 companies. So it means that your risk is low as well, because for you to lose your fund, it means all those 500 companies would have to fold up. So that is why most people are now going into ETFs, but I'm going to be discussing that at the end of this video. So make sure you stick around. Now, what are the pros for this type of equity portfolio? You have the high potential rates of capital appreciation. So if you're very familiar with stocks, or if you're not too familiar with stocks, if you buy a stock today at $20, the possibility of it going to $30, $40, $50, it's very possible, which means that your capital can easily appreciate very well. Then you have some stocks that provide dividend as well. So when you buy some stocks, they provide dividends, especially for these aristocrats companies that have been around for a very long time, that their share capital might not really appreciate much, but they pay you dividends. So I'm going to be discussing at the end of this what's the difference between a growth company and a dividends paying share as well. So make sure you stick around. So now, when you buy some shares at the end of the quarter, they pay you dividend. Whatever they make, they pay dividend to you. So when you check, when you're buying the shares and you check, you see where they wrote yield. It tells you the yield you're going to be getting. If it says 5%, that means you're going to be getting 5% per annum on whatever you invest into that company, into that shares. And that becomes a passive income to you. And you have easily liquidity, like you can easily sell your shares at any time, as long as it's not a public holiday and it's not a weekend. So you can just go to the exchange, maybe through your app, and sell your shares. So one app I use is Wealthsimple. And if you're in Canada, it's one of the most popular apps in Canada. It's very user friendly. If you want to open a Wealthsimple account, I'll put my link in the description. You can open using my referral code, and you're going to get $25 for using my referral code. So what are the cons for this type of portfolio? You have the risk, the liquidity risk. There's a risk of you losing your money. There's a risk of losing your capital. Just like it's possible for it to appreciate, there's also tendency for it to depreciate as well. Then you need to understand the market for you to be able to properly invest into this type of market, because you need to read maybe the fun fact of this company, what has been their track record before you put your fund into this type of investment, into this type of portfolio. And this is the reason most people run away from equity. But it is very good when you understand the market, when you understand what does equity mean, and you choose to put your tent maybe in dividend growing stock, which provide passive income for you. So I'm going to be having a class on how you can build your passive income using dividend stocks. It's coming up on the 29th of March. For this class, coming up on the 29th of March. If you want to join the class, the link will be in the description. You can just click and join the class. My next class is March 29th. And if you're watching this video after March 29th, there's always classes on a monthly basis. So you can just visit my store to know the next time I'll be having class on investments again. Going back to our portfolio, let's go to the fourth portfolio, which is the real estate. So when you talk about real estate, you can either go into residential property, you can go into corporate property, or that's commercial property, or you can even do the real estate investment trust funds. So when you're buying residential, when you talk about real estate generally, what you're doing is you're investing to get a rental income. So you buy a house, if you do residential, you buy a house, you put tenants in this house, and from whatever the tenant pays, maybe you pay your mortgage, you pay the property management fee, and the balance comes to you as passive income, which is your rental income. So what is the advantage on this? So when you talk about, before I go to the advantage or the pros, when you talk about the real estate investment trust, this is you owning real estate. However, when I mentioned about the residential property, I told you buy a house, you are the one that got the mortgage, you're the one that is paying for the management fee and everything. But when you talk about the real estate you're investing in a company that owns a lot of property. So there are a lot of companies that own property. They are called the investment trust. And what you can do, you can buy their shares off the stock exchange. And this is one of the things I'm going to be teaching in the class for March 29th, if you want to join the class as well. So what are the pros for this type of portfolio? You generate rental income, especially maybe if you own it yourself, you're able to generate rental income. Then there's possibility of your capital appreciating, because if you buy a house for $200,000 today, in the next 6 months, in the next 3 years, maybe 4 years down the line, it's possible that the house is now about $250,000, right? So your capital has appreciated. Then you edge against inflation. You can use your property to edge against inflation because you're putting down your capital. So possibility of the inflation out and rising your home, it's very minimal. Then what are the cons for this type of portfolio? You require large capital. So if you want to buy a house of like $300,000, buying a house is one of the largest debts you ever go into if you want to buy with a debt, right? So you require large capital for you to venture into this type of portfolio. However, if you're doing the investment trust, which is you're buying shares off the market, you do not need large capital. You can start as low as maybe $10, $15, or even low as $5, depending on your current financial situation. So make sure you join my class so that you can learn about that. Then there's market risk as well. Like prices can decline. Just the way the price can appreciate, it's possible that the price can depreciate as well. You remember the time of 2008 where everything was like crashing. So it's possible that the price can also depreciate. Then there's a cost for maintenance. So especially when you own the property, there's cost for maintenance. So you have to maintain the property. Like if something gets worse in the house, the occupants will have to call you as a landlord or the property manager to maintain. So there's that cost as well. Now let's go to the fifth type of portfolios, financial asset portfolio. You have the commodities. So when you talk about the commodities, this is where you talk about the gold, the silver, like precious metal, or you can even talk about the agricultural products like the wheat, the corn, the coffee. In this part of the world, coffee is a very big thing. And you can talk about the natural gas, the oil, and energy commodities as well. So what is the pro for this type of portfolio? You have its edge against inflation. So when you have an agricultural produce, you just invest one and over time you keep making money over it, right? And there's diversification benefits. So instead of you just putting your money maybe in the stock market, in the cash and cash equivalent, you can use this as part of the process for you to diversify your fund. And it requires storage. Sorry, it's high demand. Sorry. So there are a lot of people, a lot of countries that are in high demand for maybe agricultural produce, oil and gas. So if you invest in this type of thing, because it's in high demand, there's possibility for your capital to appreciate very fast. So what are the cons for this type of investments portfolio? There's no passive income. So remember when I said talk about dividends, maybe you invest in shares and at the end of the quarter you get returns. There is no passive income in this type of investment, and there's high volatility as well. It's possible it goes up today and it comes down tomorrow. Then you require storage and management. If you're buying a gold and you want to keep it for maybe the next 10 years because you believe that it's going to appreciate, you need to store it somewhere so that it doesn't depreciate in value. There's no stain on it, and you require a lot of care for that type of portfolio. Then the last portfolio, which is the alternative investment. So when you talk about alternative investment, that is where you talk about the cryptocurrency, the collectibles, maybe your art, maybe your wine. That's where all this come in. And the last part of this is where you talk about the private equity and the capital venture. So when you talk about alternative investment, what are the pros for this type of alternative investment? There's high potential for you to have a very massive return on your capital. Yes, because just like cryptocurrency, it's possible that you bought today and tomorrow it's like 100% increase in price. That means there's high. And when you talk about venture capital, you're investing in maybe a very small company, and there's tendency that the company might peak and you have about 1,000% return on your capital. Then this serves as portfolio diversification as well. Like you can use it to serve as a diversification for your portfolio. Just like instead of putting your money only in real estate equity, you can use this to serve as portfolio diversification. Then you have access to investments industries. So if you want to invest in the industries, you can have access to it, especially when you are looking at alternative investments. So what are the cons? There's high risk and volatility. Just like the way the price is possible for the price to go up, it's possible that the prices crashes as well. And if you're investing in a small capital, when you're doing capital venture, it's possible that a company does not actually make it out of the very small stage, and that means you're losing your capital. Then there are regulatory uncertainty, especially when you talk about the crypto market, maybe the Bitcoin and the likes. It's possible that regulatory might take off your capital because you are not so certain about the regulatory requirements, and it requires high capital investment. So if you're looking at investing in a venture, maybe, or venture capital, you'll be looking at getting a very huge capital for you to start. So these are the 6 classes of assets, financial assets we have. Now, for you to have a balanced portfolio, you need to be able to put a bits and pieces in all these portfolios so that your portfolio is balanced. So when we say balanced portfolio, it means that if there's crisis in the equity markets, other investment portfolio can actually shock the crisis that you have in the equity market. So those are the types you need to now, okay, what am I going to be putting my investment in? Now, what class of asset is right for you? Like I said, it depends on your financial situation. It depends on your financial goal. What are you trying to aim at? But if you're looking for stability and you do not want to take risk, then you might be looking at the cash and cash equivalents and the bond and debt instrument for you to invest in that type of portfolio. Then if you're looking for growth potential, then you're looking at stocks and real estate. If you're looking for inflation protection, you're looking at commodities and you're looking at real estate. If you're looking for high risk, high return, then you might be looking at cryptocurrency, which is like the alternative investments and anything under the alternative investment. So make sure you diversify and make sure you know your financial goals before you're able to pick what's and the risk you're willing to take before you're able to pick what classes of assets you want to put your funds in. Now, I'm going to be talking about self-directed investment. When you talk about self-directed investment, it means you're the one choosing all your portfolio. So I go to the stock exchange through my app, called Simple, for example, and I choose the shares I want to buy, right? I've read about the company. I know they're doing well, so I'm directing it myself. I know when to sell. I know when to buy and hold for the future. That means I'm directing it myself. Then we have the managed investment portfolio. So when you talk about the managed investment portfolio, this is when a group of people manage this portfolio for you. So you will see when you open any of these apps, like any of those brokerage apps, it tells you, do you want a self-directed investment or do you want a managed investment? So if you choose the managed investment, they already have a team that will manage those investments for you and you pay a certain fee for them managing it for you. But for self-directed investment, majorly you do not pay fee because you're the one actually managing the portfolio yourself. Now, to the bonus I said, what is growth equity? So growth equity, that's when you talk about stocks. Growth equity means that you're actually looking at company appreciation of your capital. So if I buy a company, if I see a company is a growth company, this company might not necessarily pay me dividends, but because they are going to be investing most of their gain back into the business for the company to grow. However, there's tendency that the shares for this type of company is likely to grow in the market. So if you might buy a share for $20 today, and if they pop their gain back into the business, it's possible that the share price will go up to $25. So that means it's growth. Your capital, the price of the shares is appreciating. Then when you talk about dividend equity, dividend equity your capital might not appreciate as a growth equity. However, you get passive income from this type of equity. You get passive income. Remember when I told you about the yield, that when you're looking for it a shares and it tells you, okay, this is the yield. That means they're going to be paying you dividend maybe every quarter, every month, or thereabout. So that means you're going to be getting passive income at the end of each quarter or each month. Then let's talk about the real estate investment trust. So when you talk about the real estate investment trust, just like I explained during the real estate part, that means you're going into the stock exchange to buy shares of companies that actually own multiple properties. So there are some companies that may own maybe some commercial properties, maybe like 15,000 commercial properties, and you buy their shares. So they are the one that manage everything. You do not need to come into the picture. All you're buying is just the shares. And at the end of the month, they pay you dividends, or at the end of the quarter, most real estate companies actually pay dividends. So if you do not want to go through the stress of you having to maybe own a house, get somebody to stay in the house, get somebody to manage the people in the house, then you might be thinking of going into the real estate investment trust. So I've been able to talk about the 6 classes and some other bonuses. So my next class, like I said, is March 29th. I'm going to be discussing majorly how do we build passive income using dividend stocks. So in that class, we're going to be learning what are the types of dividend stocks, how do you research about it, how do you get a brokerage account, how do you make your purchases in the market, how do you know, okay, this is a dividend stock that I need to invest my money in? And you have access to a lot of things in that class. So the link to register will be in the description if you want to register for the next class. And I hope you subscribe to my channel. If you've not subscribed, please subscribe now so that I can always bring your way financial tips on how you can make your money, how you can grow your money, and how you can multiply your money, and how you can secure your money. So till we meet the next time, I hope you remain blessed and stay blessed. Thank you.